There's certain projects out there that people will tend to believe are narrowly focused. Take financial instruments. Everyone thinks of financial institutions, big banks, but the concern is that the non-financial institution, corporates, aren't as focused. There's a number of other priority projects, revenue recognition, leasing, that's been occupying the majority of their time. So we really want to drive the awareness and understanding on how this project could impact their company.
What do we think the real impact's going to be? Or have they not been focused because they really don't think there's going to be an impact?
After the financial crisis, the current incurred model was criticized for delaying the recognition of credit losses. So the standard setters kind of went back to the table and said, you know, how can we get more timely recognition of credit losses?
The other big impetus was people kind of looked at financial statements and said, there's too many models. There's too many different impairment models. I don't understand it. Instruments with similar economic substance have different accounting models, and I think users of financial statements found that very confusing. And so what we're trying to move towards, at least as it relates to credit-related fixed income instruments, is a single model that can be applied across the board.
So you talk about some of the criticisms of the model, too little, too late, you hear. Maybe, big picture, kind of walk me through what that means. Why is that a criticism?
So under today's incurred model, a credit loss is only booked when it's probable that a loss has been incurred as of the balance sheet date. Whereas under the new model, you'd be allowed to look forward and look at expected losses. So when losses started piling up during the financial crisis, people could not yet book the losses that they expected to come in the future because they were hamstrung by an incurred model.
The new model sort of forces you to have to look forward.
Absolutely.
And take that into account, and would suggest earlier recognition of losses than what we would have today.
Yeah, arguably what it allows you to do is look at factors you're already looking at from a business perspective. From a corporate perspective, that'll impact the receivables that they have on the books from clients and from their customers. It'll impact the receivables they have in the book from leasing transactions, and it'll also impact their debt investment securities portfolio.
What this new model would be telling us is that for all trade receivables, you might have something that even is sitting in your current bucket today that's not even 30 days age that might still garner some level of allowance.
It's a joint project with the FASB and the ISB. Both boards at one point had started in a consistent place with this 3-bucket model. I think what we've seen or experiencing today is there's some divergence between the two boards.
The FASB model is viewed by many to be operationally easier than the ISB's model. However, conceptually, some struggle with the day one loss. The ISB model has an idea of, I don't book a full lifetime loss until something bad has happened on the asset. That seems to make sense to people. There should be a trigger before I record a lifetime of expected loss. But along with introducing that trigger comes complexities.
What should corporate treasurers be thinking about today?
If I was a treasurer, I'd be thinking about two things. I'd be thinking about data, and I'd be thinking about process. So data, where am I going to get the data to come up with lifetime expected losses on whether it's debt securities, receivables, lease receivables, and then on top of that, I think about process, right? I need a process in place to capture that data, to monitor that data, to update that data, to review that data for reasonableness. There's standards out there like leasing and revenue recognition that hit the bread and butter of the corporates, and I think that's rightfully so where there's attention spent. On impairment, I think the message is this will impact you. It'll impact you in a couple of areas. The impact won't be, is not likely to be to the degree that some of these other projects are that kind of hit your core and your bread and butter. Keep it on your radar screen. Take a good look through your balance sheet and really try to think about where this could impact you the most.